Hello, I hope everyone had a great finish to their summer and is enjoying the start of their fall. As we look back into the third quarter, the big story, the main talking point, is the Federal Reserve finally cutting interest rates for the first time. In their September meeting, the Federal Reserve cut rates a half a percentage point. What was interesting was after this cut in rates, we actually saw Treasury yields or bond yields and mortgage rates increase. While this might sound a bit counterintuitive, this was due to the Federal Reserve changing the expectation on how they will cut rates going forward. Looking forward, the market is still being more aggressive with their interest rate assumptions than the Federal Reserve. The market is pricing in that interest rates will be down to 3% by the end of July of next year. Meanwhile, the Federal Reserve is projecting interest rates to be at 3.4% by the end of next year. This difference between what the market is pricing in and what the Federal Reserve is projecting does raise some concerns. If the interest rates follow the path that the Federal Reserve is projecting, then we should expect some volatility within the bond and stock market as the market is assuming a more aggressive Fed than what actually could occur. Now, with this rate cut finally occurring, now is a great time for those who have been utilizing high yield savings accounts or CDs to get those high interest rates to begin transitioning back into the traditional bond market. With this increase in yields that the bond market has provided us after this interest rate cut, really just giving people a second chance to hopefully begin transitioning into the bond market and begin locking in rates before rates do begin to fall within the bond market. As we enter October, the bull market is entering its second year. While the stock market, the S&P 500, is hitting all-time highs, valuations are not as elevated as you might expect. The S&P 500 is getting pushed by having the underlying earnings of the companies continue to grow. So companies, especially in the tech sector, have been increasing their earnings, their profitability, which has helped justify some of these all-time highs that we are seeing. As we look forward, one of the big stories is the upcoming election. As we started the year off, investors said that the upcoming election was their biggest concern for the entirety of 2024. As we get closer to the election, those concerns are likely to become more elevated and seen throughout the markets by increased volatility. One thing that I think we should all remember is that markets at the end of the day tend to move past the election. In reality, the markets end up doing best when there is gridlock via split control of Congress. Historically speaking, when Congress is divided, the S&P 500 has averaged almost a 15% rate of return. Comparatively, when either party has controlled both the House and the Senate, the S&P 500 has averaged a much lower 8% rate of return. As we get closer to the election and the election becomes more forefront, increased volatility is likely. But again, good news is historically the fourth quarter of the presidential cycle ends up being a good year for the stock market. The S&P 500 has finished positive 83% of the time during that fourth quarter of a presidential cycle. So as we see this increased volatility, increased rhetoric, again, our job as prudent investors is to stay above the noise, not get caught up in rhetoric, and maintain and hold firm to sound investment principles that has shown to do well over time. I wish everyone a great beginning to their fall. I look forward to hopefully seeing everyone either one of the holiday parties or touching base with you.